Anyway, joining us right now is Mark Grant. He's the Chief Global Market Strategist at B. Riley Securities. And Mark, everybody last week was worried about inflation, looking at the CPI numbers, looking at the PPI numbers, both of them hotter than it had been expected. But you're pretty calm about all of this because you say the game is different this time around. It's not something that you're all that worried about. Why is that?
I'll explain it to you, Becky. The inflation used to be, prior to the financial crisis of 2008, 2009, a major market mover. And now it's an influencer. And the distinction is that the Fed controls both the bond and the equity markets by the amount of money that they're putting out. As a matter of fact, their balance sheet grew about $20 billion last week alone. They're about 7.8 trillion. And between the Fed and the other central banks of the world, they're up at around 23.5 trillion, which is the size of the economy of the United States. And they're really influencing the market. So it depends on what the Fed does as a reaction. And Jerome Powell has been very clear. They're not going to raise interest rates. And we're seeing the 10-year around a 162. But the other thing that's important, as you know, I deal with a lot of major money managers, is that corporate bonds, investment-grade corporate bonds, high-yield bonds, mortgage bonds, have all contracted against treasuries. So it's very difficult to find yield anywhere. As a matter of fact, the high-yield market, as an example, using the Bloomberg Barclays Index, is right off the lowest yield that it's ever been. So we're seeing something very different now with the Fed in controlling the markets than it used to be prior to the 2008 and 9 crisis.
Does this just go back to that old axiom that you can't fight the Fed, Mark?
Of course, you can't fight anybody that can make money, where you'd go to jail if you tried to do the same thing. So the Fed gets to make money by the blink of their eye, and it's not possible to fight the people that make the money.
It's weird, though. There's two different influences. The Fed gets to make money, and it can control a large part of the market. But with the federal spending that's now taking place, that's another great wave. I mean, you would think in either case you wouldn't fight either one of those. But what happens when the two of them collide?
Well, they are colliding. We had the 1.8 trillion stimulus package passed. Now they're talking about a total of another $4 trillion in additional money. They are colliding. And that's why, in my opinion, the Fed will never admit this ever, but the Fed's holding down interest rates because the government can't afford to pay higher rates. So it's a borrower's paradise. But of course, for pension funds, seniors, retirees, it's a disaster. They can't find any yield. I found some yield in some closed-end funds and some exchange-traded funds, but the bond market, which used to be the provider of yield for investors, you can't find any yield any longer.
What does that mean for stocks?
Well, as long as there's a huge correlation, Becky, between every time the Fed puts in more money, and they're likely by the end of this quarter to be around 8 trillion. So it's basically a positive for stocks. But then you also have, at the moment, in my opinion, a lot of froth in the market. You have almost a gambling mentality with some of this stuff. And then Bitcoin. And, I think speculation, meaning, buying something at one price and hoping it goes higher, is fine. I think plays for yield and cash flows are a very important part of the market. But I'm not the gambling type. So I think people have to be careful what they're doing in there.
And when the Fed, forget about raising rates, but when the Fed says that it's going to taper, that it's going to stop buying as much as it's been doing in the market, what's the reaction then?
It's going to be a negative reaction, Becky, but I don't expect that to take place. If you believe Jerome Powell and what he says, and I do, he said it's not going to take place at all until sometime in 2023 or early 2024. So
well, that's raising rates, I thought, not tapering.
Well, yeah, it would be raising rates, but tapering would in effect raise rates because then the Fed wouldn't be able to hold interest rates down any longer.
You don't think the Fed's going to keep buying at the same clip and never talk about even tapering all the way to 2023, do you?
Yes, I do. I don't think they're going to taper at all, and I think we're going to be in a very low interest rate environment for the foreseeable future. The government can't afford higher interest rates, and we have all these stimulus packages, and we're increasing the national debt. We're at about 129% debt to GDP ratio right now, Becky, and the Fed is the one that's controlling the fact that we don't have higher rates.
So the bond vigilantes can't do anything?
Can't do a thing. They're totally put out into the pasture. You can't fight the people that make the money, just like you said.
Shepard Smith here. Thanks for watching CNBC on YouTube.